Is this a cyclical bear in a secular bull, or do you think it's something much more serious?
Well, it's a bear market. When you say much more serious, we've had recession.
Is it a 10-year bear market, or is it a 1-year or 2-year bear market?
Well, last time on the show, even though I'm not an overly religious person, I told you I felt a little bit like the Pharaoh had a dream. And his dream, which was covered in the Bible, was interpreted by Joseph. And his dream was we would have 7 lean years following the 7 fat years. Now, I'm not making a 7-year forecast, but I believe we've gone through one of the most speculative periods I'm aware of. SPACs and all that kind of crap that was going on, crypto and non-fungible tokens and stuff like that. And I think it would be unlikely to go back into a bull market anytime soon. So I would think we're in store for an extended period of time where returns in the equity market will be very modest. So, I had that experience personally. And I got my MBA, I think I said this on TV before, I got my MBA on January 31st of 1967. My son, who's now about 55, was 6 months old, had no money in the bank, had a student loan to repay. I couldn't afford a vacation. So the very next day, I started my career in Wall Street. I joined Goldman Sachs February 1st of 67. You check the recs, the Dow was roughly 1,000. In 1982, 15 years later, it was 1,000. And I made my money picking stocks. So I think we're in that kind of environment. But I would say overall, I'm very concerned that we've had a very, very toxic combination of fiscal monetary policies the last number of years. We borrow from the future, and we're in a give-back period now.
Yep.
And
Lee, that sounds like it qualifies for a secular bear. We've had people argue that we're still in a secular bull and that this is a cyclical bear. So you're saying, I asked someone earlier on the show about the size of the bubble that was inflated, or the amount.
The bubble was in fixed income. The bubble was in fixed income, and the would-be FANGs, which have been destroyed. I don't own any of these things, but I look at symbols. CLOB down 93%, ROT down 92%. I do know Robinhood down 86% from the highs. These are enormous declines. This whole meme game. I mean, we saw this extraordinary speculation, and I'm quite confident that this stuff does not go away very quickly. It leaves some scars. I think we've had aggregate drawdown in wealth equal to what happened in 2008. If somebody lost their money, it's going to affect their thinking. And this buy on weakness stuff has got to give way to get me out type of philosophy. So I think Kathy Wood's a very bright lady, very competent, but my guess is she'll have outflows at the bottom, not inflows that she's experiencing now.
Lee, the last time I was on the show, you were on the show, it was a year and a half ago, and the S&P was at 22. And I remember you just did a very basic analysis, and you said, look, the S&P is fairly priced because the risk-free rate is effectively zero. These are the earnings on the S&P. 22 times feels about right. But if the rates change or the earnings change, your view would change. So now we're sitting here. The S&P is at 15. It's very, rates have already increased. They're going to increase further. Are we fairly priced here at 15 times on the S&P 500 given the current environment? Or do you think that 15 times is going down?
Well, I think the 15 times is going up because I think we're going to have a recession and profits are going to drop. So a typical recession, profits drop 20%. So earnings are running around 220, 225 now, but I would expect that we'll probably head towards 180. I think the price of oil or the Fed will push us into a recession sometime next year. I think there's too much liquidity in the system to experience this recession this year, but I think we'll have a recession sometime in 2023. And the market will, on average, go lower. Now, let me just be very clear. Equities are the best house in the financial asset neighborhood, in my opinion. But I don't like the neighborhood for various reasons. We borrow from the future through extremely inappropriate fiscal monetary policies. I think inflation is likely to be worse than generally expected. Powell has been very wrong on inflation. And while he has some cover from the Ukraine war, reality is he was wrong in a very big way even before the war. The word transitory was inappropriate. They elevated societal issues relative to inflation as they're concerned. Labor has got the upper hand now, and that's going to be bad for profit margins. And interest rates are still too low relative to inflation. When I grew up, the 10-year government used to have a real return. So if you have nominal GDP running ahead at 10%, you know, that's what I think is running, nominal GDP, and you have 10-year governments at 330 or 335, whatever they are, you know, I think there's scope for further increases in interest rates. Now, stocks are heterogeneous. There's a lot of stocks that are probably bottoming now, and we all can't pick the bottom. We can't buy the bottom, we can't sell the top, because if everybody bought the bottom and sold the top will be the bottom will be the top. So you got to kind of just go in slowly. I'm more invested than I want to be, so I've been a seller on strength and not a buyer on weakness. And I think we can have a significant rally at any time. But my basic viewpoint is the 4,800 of the S&P is likely to be a high for quite some time. That's why I would probably separate myself from the crowd. When the crowd is talking more cyclical, short-term stuff, I think we're going to go through a prolonged period of low returns as we try to right the ship, unless we're heading to fiat currency. But you know, I'm going with the Pharaoh.
Well,
You know?
Lee, would you urge? We understand what you're saying about the Fed. They're in a tough spot. I guess they need to raise rates.
Put themselves in that tough spot.
They did, but they got to do. But what about policymakers? I wonder what the right formula would be for whether would you urge that they don't do anything? I mean, they might raise taxes. They might cut taxes. Who knows? Depending on who's in office. Is there anything policymakers?
Yeah,
They probably shouldn't do Build Back Better. I would imagine you think they probably shouldn't spend a lot more money on throwing money at a problem. So what should they? They shouldn't do anything, or they should do something.
They should basically understand whether we're a capitalistic system or not. We should basically give an incentive to the oil companies to produce more, rather than criticize them for excess profits. You know, to me, what I would be doing is tell the oil companies, we'll guarantee you $100 a barrel in oil as we fill the strategic petroleum reserve, and you'll get more production. You know, and we're just following the wrong policies by criticizing them. You know, we should be criticizing ourselves for just very bad policies that led to the problems we're having presently. I'm a capitalist with a heart, okay, and I have common sense, I think, and I don't think you get more production out of the oil industry by criticizing them for excess profits. You got to give them an incentive to produce. And I would just say that in bear markets, you never know how low is. I'm assuming by the time this is over, if we fall into a recession, that the market could have declined 40% from its peak. That's my basic modus operandi. And because I think we're in store for an extended period of low returns, I only want to buy stocks that pay me to be patient, meaning they pay a dividend, or they have a kind of balance sheet to buy back cheap stock when they believe it's cheap.
Lee, the Nasdaq's down 33, so that's not too bad for the Nasdaq. You're talking about the S&P, which is only down 20 and change. So you think the S&P goes down 40%?
Well, if I'm right that we wind up with a recession, yes, it won't happen this year. I think the low this year is probably not materially below where we are, as a guess. I think if the Fed raises 75 basis points tomorrow, people will say, well, they're now serious about fighting inflation, they'll feel a little bit better. But I think being conservative, being cautious is the right approach. You know, like I said, I'm a seller on strength, I'm not a buyer on weakness, and I think that the bottom is not in yet, and I'm basically taking it very conservatively, which is not to say there are not cheap stocks around. There are plenty of cheap stocks around. I own a bunch of them, and I just am being patient, that's all.
Hey Lee, can I go back to something you said that was pretty scary to me? There's still a few analysts out there that have, you know, S&P earnings in 2023 of like 250, 7, 8, 9% growth, and I think you said 180.
Well, I'm assuming, again, you have to make an assumption. I'm assuming sometime in the next 12 to 18 months we have a recession, and profits typically drop in a recession. You know, we've been here before. Every economic recovery sows the seeds for the next recession. Every recession sows the seeds for the next recovery. You know, we haven't had a recession since 2008. So what is that, 12 years, 13, 14 years of economic expansion? So we're overdue. We've had policies that have pulled forward demand. We see a shift in the power between labor and business, which is not going to be positive for margins. So, you know, I would say a conservative approach is appropriate. that I think 180 is more probable than 250 in terms of earnings. And then you got to get to the multiple. I'm assuming as earnings go down, the multiple should go up. So I'm assuming maybe an 18 multiple on 180 would be close to 3,000. That'd be maybe the ultimate bottom for the S&P. But again, that assumes recession. If we don't have a recession, I'll be too conservative.
Lee, you said you have a bunch of stocks that you think are cheap. Our viewers are always looking for opportunities. You want to tell us about a couple quickly?
Yeah, well, my biggest position happens to be a bond, and that's Legato. It's too complicated to discuss on the phone, but I think there's a 100% return in 15 months in the first lien paper, which I think is very attractive. I own a lot of Google. It's 15.4 times next year's earnings. I own a lot of Motorola Solutions, which is a higher multiple, but it's probably a 15-20% grower. Lithium Motors, selling at 6 times earnings. Energy Transfer, 8 times earnings. I had breakfast with a stock that's gone from 2 to 38. I had breakfast with the CEO, and I was wondering whether I should just take some profits. And after I got finished talking with him, I said, the damn thing is cheap. So this is a company called Paramount Resources, a Canadian oil and gas company. They have 142 million shares outstanding. They're generating $1 billion of free cash flow after spending $600 million on CapEx and paying a dividend of about 3%. They also have about $5 per share of their stock in other people's energy stocks that don't add to earnings. And so, it's selling at between 3 and 4 times cash flow. Their production cost to produce a barrel of oil is about $31. They're making a fortune. And I don't know anybody that's credible that sees the price of oil much below $85 a barrel. I think there's a $25 premium in it for the Ukraine war, but at $85 a barrel, they make a lot of money. And I think, frankly, we'd be better off if the price of oil dropped a bit, because that would really delay demand destruction. So those are some. I like Cigna, I like Apollo. There's plenty of things you could be doing, but I think overall, a conservative approach is warranted in the market. I think inflation is likely to be worse than we expected. Labor's got the upper hand. And I think over the next 12, 18 months, we're going to be in a rising interest rate environment. Inflation is going to remain relatively high. I think somewhere we have to address our fiscal policy. So, taxes may have to go up, unless we're going into fiat currency. In 2020, our national debt was $20 trillion. I'm sorry, 2017 was $20 trillion. In 2022, it's $30 trillion. So we've had an increase of 50% in our national debt in a matter of 5 or 6 years. It's concerning to me. And you got Joe Manchin trying to keep us on the reservation, and you got an administration that seems to be wanting to, put out debt left and right. And there's a price to pay for that, I think.
All right, Lee, great to have you on today. Thank you.